Perfect. So, good afternoon and good morning to all. We are here for today's webinar, where GTPN and MDDP are together hosting this session on unlocking the UAE Poland business corridor as a strategic partnership and involvement of MDDP in the GTPN network. It helps GTPN to show its presence in Central and Eastern Europe, and where MDDP, a tier one firm, brings Poland and the Central and Eastern Europe expertise in terms of tax advisory. And this partnership helps both the firms to serve their clientele with a wider variety of services, jurisdictions, and also the technology that GTPN's tech side focuses on. So today's discussion, we will focus on three main aspects, and one of it being using UAE as the corridor for the Middle East and Africa, using Poland as a corridor for the entry to the European Union, and not just Central and Eastern Europe, but the larger European Union, and how does the tax and regulatory framework functions between these two jurisdictions, and how are the macroeconomic factors supporting, and why this corridor or the trade corridor has become really important. So with us today we have Bartos and Magdalena from MDDP and Anand and Praneeth from GTPN. So I'll just do quick intros and then we directly delve deeper into whatever uh, this session holds for us and what you guys have prepared for us. Right. So to introduce, Bartos is the partner of international tax at MDDP with more than 2 decades of experience in tax and legal advisory. He specializes across all the tough parts, that is on corporate income tax, international tax, withholding tax, expansions, Estonian corporate income tax regime, the IP box regime, and he supports foreign investors entering into Poland and Polish business expansion internationally. So he's a guy for both outbound and inbound expansions. Then we have Magdalena, who is the partner transfer pricing at MDDP, again with almost 2 decades of experience. She's leading the transfer pricing team for as long as I can remember for MDDP. She's been regarded as the most highly regarded transfer pricing expert for more than 3 consecutive years by the International Tax Review, and she takes care in and out of transfer pricing, whatever you can think of, from the settlements, benchmarking, documentation, even complex transactions on, financial transactions, guarantees, royalties. So she has led, I think, one of the most complex Polish transfer pricing projects in the recent past. And I also welcome my partners, Praneeth and Anand. So Praneeth is GTPN's global TPN structuring advisory leader with more than 12 years of experience across transfer pricing, cross-border structuring, pillar two benchmarking, and controversy management now. He has supported clients across APAC, Middle East, and is currently leading the transfer pricing team at the Center of Excellence of GTPN and serving approximately 31 countries. The standout part or an X factor about Praneeth is he's not just a chartered accountant by qualification, he is also a CMA and a CFA. So a complex guy with complex numbers. We leave him to those numbers most of the times. Then we have Anand, who is GTPN's business advisory and tax technology leader with more than 15 years of experience across Europe, Africa, Middle East. And he has advised CFOs and tax leaders to align their business strategies with their tax, the transfer pricing models, operation transfer pricing. And the X factor about Anand is that he leads the GTPN's tax technology initiative with offices in UK and Brazil for tax technology. So this is our lineup for today. So I understand it's a very exciting lineup, and I have some very difficult yet uh, you know basic questions for them as we move forward, and we will see how this pans out. So we will discuss first the Polish side, of the regulatory and the business environment, then the UAE side of the regulatory and the business environment, followed by transfer pricing, of course. So that's the agenda for today, right? I would also like to acknowledge our not-for-profit called Voice of CA. It was established in 2009, and it has been powering us on all the technical capabilities that we have to conduct this webinar. So an acknowledgement for them as well. And with this, I think we can start. Are you guys ready for the questions that I have for you?
Yes.
Perfect. I see
Yes, of
those
course.
smiles and the nods. Perfect. So, and I hope the slides are also visible.
Yep.
Yeah,
Super. So before we get into, the tax and structuring aspects, Anand, can you set a broader context as to why the UAE Poland corridor is relevant, more relevant now, and which sectors are driving the momentum on this corridor?
great, Rishabh. Thank you, Rishabh, for the warm welcome. Good afternoon, everyone. My colleagues, anyway, will deep dive into the tax and regulatory framework. And I would like to spend a couple of minutes here looking at a macroeconomic lens because every investment decision starts with one fundamental question. Why this market now? Why now? What we have seen increasingly across the businesses, they are no longer asking where they should establish their next business or an entity. What they are looking at more is what is your strategic question in terms is which regional business corridor is best for our next phase of international growth. I think this has been always the question that we have seen, and that is where exactly today why the Poland and UAE corridor deserves the right attention today. Most of the multinationals are increasingly viewing Poland and the UAE not as a competing investment, but more of a complementary gateways with a single regional operating model. Poland provides access to European Union and Central and Eastern Europe, and UAE provide access to GCC, Africa, and wider Asia Pacific countries. They create a powerful economic corridor connecting established European markets as well as the regional markets in the world's fastest growing economies. From a commercial opportunity, I could clearly see on the slide the bilateral trade between the UAE and Poland reached approximately USD 2.2 billion in 2024, and which is growing now, demonstrating a real strong and growing commercial relationships between these two countries. However, I always feel as an economist, the trade only tells us where the products move, but also I feel the investment is exactly where it tells us where the businesses are long term having the confidence. Again, today, UAE investment into Poland stands at approximately USD 195 million, led by certain sectors I can clearly see aviation, tourism, and technology. At the same time, Polish investment in UAE has reached approximately USD 310 million across real estate, technology, and trading. These figures clearly tells us something important business in terms of both jurisdictions and also in terms of establishing operations and building long-term collaboration. That's the outlook I wanted to talk about. And further, I could also clearly see a underlying institutional support, which is equally encouraging, especially from the Dubai Chambers has established its Warsaw office. And today I could see more than 450 Polish companies are already operating in the UAE. Looking ahead, I believe the next phase of growth in Poland-UAE relationship will be driven by cross-border investment as businesses are establishing manufacturing operations, regional headquarters. So I think with this, I would like to say that this is the strategic gateway, and this is what we're currently looking at as the business corridor. And I leave other participants to take up on what are the cross-border tax considerations.
Right. Thanks, Anand. I think the good part about today is we are going to explore both sides of the gate. So we'll start with Poland first. So to Bartosz, why should UAE businesses or, the businesses in this region, in the Middle East or the GCC region, look at Poland as a gateway to Europe?
Well, thank you and hello, good morning and good afternoon. Uh, why? Well, first of all, we got both the mountains and the sea, and Poland is beautiful country with near 40 million citizens. But what is also important, we are part of the European Union. Poland is a member state of OECD for like 30 years for now. And we can be treated like easy entry for both European Union, but also not only European Union countries. Poland is, well, maybe we are not in G20, but we are in G21. So, and we are still growing. Poland has concluded nearly 100 double tax treaties, which is quite a number. We got also like 15 tax information exchange agreement with different very interesting locations. Poland can be seen as place where taxes are pretty friendly, at least comparing to other EU countries, also called Old Europe. We got quite flexible and friendly companies law. You can even like create a company within one day if it's necessary. Cost of labor is not as high as in other countries, mainly Western countries. I mean, in the European Union. What is also interesting, we are pretty digitalized economy, so you can like discuss all your personal or business matters with the authorities via the internet. You can file a complaint even to the court via internet. You can open a bank account within few minutes using just your phone and application on your iPhone or Android phone. You can have your like ID or driving license in the phone. You don't need any paper carrying on you. So that's that's where we are, and we are still growing and developing and become more and more technically advanced. And speaking about the taxes, if you please switch to the next page. As I said, Poland has pretty friendly and interesting tax system, including corporate income tax, but not only. One may say that Poland is a tax heaven in European Union. If you ask an average Pole, what is the corporate income tax rate in Poland, he will tell you 19%. Yes, there is 19% corporate income tax rate in Poland, but that's only part of the story, because as you may see, there are different rates applying to different sources of income and depending on the nature of your business and the size of your business. The most interesting one is, of course, 0% corporate income tax rate. Yes, it is. It is. It applies mainly to business carried out in special economic zones. So you have when you develop your business in a special economic zone, the income from that business will be simply tax exempt from income tax in Poland. There are also private foundations, investment funds, and some other entities that do not pay income tax at all. There is also 5% corporate income tax rate. If you are carrying on some research and development in Poland, and as a result, you create some sort of intellectual property, the profit arising from that property, from that IP, can be taxed with 5% corporate income tax according to our IP box system, which is also quite interesting. If you are a small taxpayer, I mean having the annual turnover not exceeding 2 million euros, you are entitled to pay only 9% corporate income tax on your operating income. Capital gains are taxed with 19%, and as well as regular business income exceeding 2 million euros when you are no longer a small taxpayer. There is also a specific system applying to some companies. It's an option. You can be taxed with 20% of corporate income tax. This system is called Estonian corporate income tax. Why Estonian? Because we borrowed the concept from Estonia, but also Lithuania, as far as I remember. In general, this system allows you to reinvest your money without taxes, I mean before the tax, because the tax only appears only at the time of a distribution to shareholders, which is quite interesting. So in fact, it works a little bit like an investment fund, but it's like addressed to operational activity. Can we please move on?
Right. I think this
Unless
adds
you have
on.
questions, of course. Yeah.
Yeah. So I think this adds on that it's a very competitive tax regime, and what we see on a common search as a headline rate of 19% is not the ground reality, especially with this IP box
Mhm.
regime and small taxpayer. And when I'm listening to this, I see a lot of resemblance as to what we have in the UAE as well. We see it in the later part, but we also have something similar, different rates but similar concepts from a corporate tax perspective in the UAE, right? So I think would you like to touch upon different business structures and withholding taxes,
Mhm.
how the repatriation works, and how the holding company regime works?
Yes, of course. So considering business structures in Poland, in fact, there are like we have plenty of entities that may be used. Of course, you can be like sole proprietor, but if you are going to invest in Poland, the most popular structures are structures based on a limited liability company and joint stock company. Both companies are legal persons, corporate income tax payers, and well, what is interesting that limited liability company can be incorporated via internet within 24 hours. Of course, it will not be tailor-made company. It will be some sort of, generic company, but you can, if you need a company like right away, you can simply, you don't have to go to the notary public and etc., but you can simply make this, you can simply create a company via internet within 24 hours and later on adjust it to your needs, which is quite interesting. There are no specific requirements considering the shareholders. So it can be individual, it could be corporation, it could be non-Polish entity, etc. In fact, there are no limitations. So our system is pretty friendly, so to speak. We know such structures are buyback of shares, redemptions of shares without no remuneration. You can set different rules about regarding the distributions of profits, etc. Besides companies, limited company or joint stock company, there are also partnerships in Poland, limited partnership, general partnership. What is important, partnerships usually are also treated as corporate income taxpayers. There is only simple partnership between individuals that is treated tax transparent. In general, it is very hard to have tax transparent structure in Poland, considering structures involving companies or partnerships. Yeah, so that's I think the most important information about business structures in Poland. So from the perspective of foreign investors, what is important is of course the withholding tax on outcoming transfers and distributions of profits, but not only. And if you are interested in investing via Poland, you should also remember that we have the holding company regime. And if you would like to have some business, which is, as I said before, not taxed or at least partially, you should remember that there is an investment zone in Poland that makes you carry out business with no income tax on it. And Considering withholding tax, there are two standard rates of withholding tax. It's 19% and 20%. 90% goes to dividends and interest, royalties, and some intangible services. Fees for intangible services usually triggers 20% withholding tax. At the time the payment is made, Polish entity making the payment simply has to withhold part of the payment unless there is some sort of gross up and pay the tax to the tax office. Of course, these rates can be reduced using relevant double tax treaty. In case of United Arab Emirates, there is a double tax treaty which allows dividend interests and royalties to be taxed with 5% withholding tax. So of course there are some requirements regarding the substance, the business, the beneficial ownership of the income, etc., etc. But in general, it usually these standard rates are not applicable. Yeah. We are also, because we are we are part of the European Union, we have this common system of participation exemption that applies to both interest, royalties, and dividends. It works, it is quite simple. So dividends paid between companies from different member states in the European Union are exempt from income tax. At both withholding tax, I mean the tax at source, at the same time, the tax in the country of the residence. On the other hand, royalties and interest is exempt only is exempt only from the withholding tax, but it's still, I believe, pretty interesting. Okay, can we move on?
Yes, yes, Bahadur, so I have an intervening question
Okay.
over here. So Poland seems to be a good destination for holding companies. So not just from a geographic standpoint, but also from a regulatory and a tax standpoint. So if someone wants to expand within the European Union, a Polish holding company makes sense because of the EU participation exemption. And then finally, if you have a tax treaty with the relevant host country,
Mhm.
so the repatriation will even can go as low as 5% for dividends and even interest and royalties.
Yes, of course. And
Yeah.
we can always imagine like two-tier structure where there is Poland and also some different country. And so the repatriation can be even with like 0% withholding tax from considering Poland. But maybe just a few more words about withholding tax, because it's how the tax is collected is not as simple as it looks like. Because if a Polish company pays something to unrelated party, in general, it is allowed to apply double tax treaty and having, of course, tax residency certificate, etc., etc. However, if a company is paying a dividend or royalties or interest to a related party, there is something that we call pay and refund, which means that it is triggered if the payment, if the aggregated amount of payments during the tax year exceeds 2 million zlotys. In the case like, in general, the tax must be withheld in Poland at the standard rate, and you need simply ask for a refund. Yeah? There are some instruments to skip this system, but they require some sort of interaction with the tax authorities, asking for a clearance, etc., etc. So, of course, you can still try to apply the relief at source, but you will have to do this with the consent of the tax authorities, so to speak.
Perfect. So related party transactions are still monitored closely
Yes,
with
yes,
respect,
and
even
there
with
is.
respect to withholding taxes.
Yes, and there is some sort of reporting required. So I mean, Polish entity is expected to file information to the tax office that like annual summary of payments done abroad and the tax with the amount of tax we've held, etc., etc. So it's pretty complicated from purely Polish perspective. Yeah? But it's just a reporting.
Right.
And
And
luckily, you can do this electronically.
perfect. So that's what we can solve.
Yeah,
That's a problem that we can
that
solve.
is something that we can do. So it's not as bad as it looks like.
Perfect. So if from this I understand, that the Polish holding company regime becomes key. So if you could just throw light on that aspect as well.
Yeah. That's it, that Polish holding company. You mentioned that Poland can be treated as an interesting place for having a holding company. Yes, it is. And it is Polish holding company. It's not it's not a specific company. It's just a company. It can be limited liability company. It can be like a joint stock company. Uh, if that company holds 10% of shares directly in a subsidiary in Poland or in any other country, uh, mm, Polish entity, that Polish company, and the shareholding period is for not less than 2 years. Capital gains, which is usually taxed with 19% income tax in Poland, will be exempt from tax. So the only limitation is that the holding company or this exemption does not apply if the subsidiary is a real estate company. I mean, where there's are the underlying asset, real property located in Poland, and if the transaction is between related parties. So you cannot exempt your capital gain from capital gains tax if you're selling a company within the group. Yeah? But on the other hand, it's still quite interesting solution because not only capital gains are exempt from tax, but also dividends received. So we can assume that there is some sort of structure in a like low tax country where the subsidiary is seated and the dividend received from that country can be also exempt from income tax in Poland, even if the subsidiary is not a EU member state company.
Perfect. I think Badru, this seems to continues to get even more interesting. We'll circle back uh, on the Polish investment zone incentive, but we'll talk a bit about UAE side as well of this corridor. So Anand, to you, why should Polish and other European business look towards UAE as a gateway to GCC and Asia, Africa and Asia? I know it's been happening for a very long time. But what do you think are the particular strengths, even considering the current geopolitical scenario?
Thanks, Rishabh, and thanks, Bartos. It's quite interesting. I think the broader question, again, we keep asking is why businesses keep selecting UAE as their preferred gateway business hub. From our experience advising the multinationals across Middle East and Asia, I think the decision is not rarely driven by just a tax alone. It usually based on the supporting long-term commercial growth while also having a stable regulatory tax environment. I think that is where UAE has developed a strong value proposition. I think the first element is, of course, the strategic geographic location, how it is there. And the second one is how open and diversified economy it is in terms of having the ability of regional procurement, the distribution, also making sure that to have in terms of how well connected on the business side to run the logistic operational activities. I think the other thing that we have seen is this is always helped having the world-class infrastructure over the last decade. That is where the lot of government investment has gone down and also encouraging private players to come in and build the world-class infrastructure. While ports and airports are often highlighted, the real advantages that being here in the last 8 years that I have seen is the integrated ecosystem in terms of digital connectivity, the logistic capabilities, and also the financial institutions. I think that is where the value that I have seen. And of course, now we are moving into the competitive tax ecosystem as well, where recently introduction of the corporate tax, which Pranit would give more insights into that, and maintaining one of the corporate tax environments, and finally the specialized free zone ecosystem and the government's continued investment in innovation and future-led economy on the digital different kind of digital businesses, also having different setups in terms of exchanges for crypto businesses. We have seen a considerable movement from Hong Kong, from Singapore, and other diversified economies here. I think the question again highlights, Rishabh, the part that you asked about the resilience in the recent months that we what we have went through. But still, what we also have seen is going forward, I would say still the talent is still there. And then considering there is a tremendous investment on the innovation side, we see that the businesses are going to grow and then have more opportunity towards the corridor. I also wanted to highlight, probably on the next slide, on the commercial and regulatory advantages as well. If you look at the UAE over the last decade, the pace of regulatory reform has been remarkable. The objective has not simply been to attract investment, but to create a business environment where international businesses can establish, expand, and manage regional operations with confidence. Starting with 100% foreign ownership across most business activities. For multinationals, this provides a greater strategic control, simplifies governance, and allows ownership structures to align more closely with the global group policies. I think that's one of the ask most of the larger groups that who wants to invest in the region, and they wanted to be more independent and be 100%. They wanted to have an oversight on what kind of business that they're trying to set up and do. And second thing is the digital business incorporation. It's more easier for investors in terms of how they're doing the company formation, licensing, the government interactions. Most of it is digital. You have you can work in terms of the timelines. At least you have an understanding that what would be the ideal timeline that you can set up. And then the corporate legislation itself, in terms of modernization, the greater flexibility around structures, the ownership arrangements, and also business reorganizations enable groups to adapt their legal structures. I think that's also important to see how flexible that a country gives an opportunity in terms of multiple share classes are permitted, redomiciliation of foreign entities is permitted, and finally the efficient regulatory framework. So if I have to like overall put it there from an international tax perspective, you're looking at OECD standards where and looking at where Bartos also made a highlight about in terms of where decisions, the substance needs to be taken care. If you have the right business people, I think UAE is the great destination to do the business. Over to you, Rishabh.
Super. So I think from both ends, same principles emerge with respect to substance, digitalization, speed of getting the work done, and also the autonomy and the ownership, which encourages both, the foreign investments and also the day-to-day operations and efficiency of MNEs operating in the region. No matter how much we say that tax really doesn't impact the business situation, but I think tax is one of the major uh, role player when we are deciding as to what gateway or what jurisdiction to choose as a next move in the organization. So, Praneeth, if you could just detail a bit as to the how how the taxes have evolved in this region in the UAE and how they are impacting, and even after introduction of corporate tax, how the businesses continue to flourish and continue to operate within the UAE.
Thanks, Rishabh. Good afternoon and good morning, everyone. I think Anand sort of already set a broader context. See, I think we have to take a step back and see why UAE has introduced the corporate tax regime. I would see three reasons mainly. One was, of course, greatly pressure because if UAE has no corporate tax, it has seen as a jurisdiction for base erosion and profit shifting. That was one reason. Second, because of UAE commitment to OECD BEPS project, where the overarching principle has been to tax profits where the economic activity has happened, thereby sort of bringing a level playing field between the domestic as well as multinational businesses. That was the second reason. Third, again, not a main reason to sort of diversify the revenue sources to the UAE jurisdiction from non-oil, non-tourism to federal tax cash collections. These are the three reasons. Now, with all this positive side, one of the important question that all the legacy investors and business men ask is whether the introduction of UAE corporate tax regime has done good, or is it something to be viewed negatively? One of the important point that we keep emphasizing across is it sort of brought certainty to all the structures. The structural uncertainty of the risk of being grey listed or blacklisted by seeing as a jurisdiction for harmful tax practices is gone. That's one thing. Second thing is this is no more seen, or the allegations of zero tax or no substance or pass-through sort of jurisdictions are gone now, because the corporate tax and transfer pricing emphasizes a lot on substance, documentation, and condition intensive. These all in all, I would say these are positive side. Now on the corporate tax rates itself, you see 0% still holds good for free zones which satisfy certain conditions, and then we have a headline rate of 9%. So while there is a introduction of corporate tax regime, it's more competitive, I would say, most competitive to be clear across the jurisdictions, because you don't get 9% anywhere. On top of it, we also have Pillar 2 with a floor of 15% that largely affects the large multinationals. Now, honest opinion from a business side, of course, there is increase in compliance cost and burden, especially for SMEs. For large multinationals, as I reiterated, it only brings structural certainty and long-term peace, I would say. The reason why there is a lot of burden is now we have the entire gamut of tax ecosystem in place. VAT, customs, corporate tax, transfer pricing, and even Pillar 2 alignment. So it's not a tax function in silo. You'll have to start from for banking transactions, to accounting, audit, and then take care of your tax planning and compliance obligations. From a tax administration perspective, the lever of race to the bottom to lure businesses is gone from a UAE standpoint. So you have to drive or invite businesses based on the fundamentals, which is your demand and supply side factors, be it your labor, capital, intangibles, infrastructure, people, and everything. So that race to the bottom is gone. And on a contrary, the reason why UAE was among first to implement Pillar 2, because they were the ones who had lower corporate tax rate. On the other side, logically, the reason why they've rushed to implement this 15% floor is not to cede their tax revenue to other jurisdictions because of IAR or UTPR. So logically, and it makes sense, all the Gulf countries or low tax countries were the first to implement QDMTT based Pillar 2 framework. Now, one more interesting aspect is there are a lot of reliefs and exemptions made it within the broader corporate tax framework. These are not pure tax positions, I would say. It's more of economic levers. There is an intent behind each of these reliefs. If you see participation exemption and business restructuring relief, that is to strengthen the holdco or headquarter regime. And then R&D tax credits is again to drive the UAE is one of the innovation hubs. And then SBR, while it's transitional and as sunset, it's more to support the SMEs during the initial induction of corporate tax. So I leave it here. So it might look simple, the overall corporate tax framework with 0%, 9%, and 15%. but it's very young, rapidly evolving, and that brings the complexity, and it would require expert advice and handholding. Yeah. Over
Right.
to you.
So I think Praneeth has bridged the gap, and now all of us can understand that, as I was mentioning, there's similar things between the Polish tax regime and the UAE tax regime, and now we see even similar terms. So participation exemption, the small business or taxpayer tax rate, R&D credits, or an IP box regime, though they operate differently, but the idea is same to promote research and development within that jurisdiction and give some sort of incentive if you're earning any income from that kind of activity. So with this, I think we can enter into transfer pricing, because that becomes a key aspect whenever we are talking about a cross-border transaction or a cross-border structure or M&Es. And for that matter, not even multinationals, we will see, with respect to the regimes, that who is covered and what sort of documentation and compliances are required. So, Magda, if you could briefly touch upon, the transfer pricing framework in Poland, how it is aligning to the OECD principles, or if there is any deviation, and more about compliances and penalties, if you could do that, please.
Okay, thank you, Risha, for the question. Hello, good morning, good afternoon, everyone. So, Poland transfer pricing framework is largely aligned with the OECD transfer pricing guidelines because, as Bartosz mentioned, Poland is a part of OECD, and we follow the three-tier documentation approach consisting of local file, master file, and of course, country-by-country reporting where applicable. So for international investors, this creates a familiar language, so functions, asset risks, arm's length principle, and economic substance. But of course, the business point is that transfer pricing should not be treated as a documentation you prepared at the end of the tax year. It should be built into the investment model from the beginning, because of course it affects margins, cash flows, governance, and of course the defensibility of the whole structure. As I said, Poland is follow the OECD concept of this three-tier documentation approach. But international investors should be aware of some local requirements. So TPR form, TP declaration, which is submitted by the Polish taxpayers to the tax office. And this TP declaration, TPR form, contains detailed transfer pricing information, like the type of transaction, the value of the transaction, the outcome of the transaction, and even the outcome of the benchmarking study. So the tax authorities can easily analyze if the outcome of transaction is falls within the transfer pricing range. And this is the key tool used by the tax authorities in Poland to select taxpayers for TP audit. But of course, the webinar is not only about the compliance. So for the management, these documents, so this documentation and all these TP documents are evidence of the business model. So they should say the same story as the legal agreements, board materials, and accounting entries. And if those elements are aligned, the structure is easy to defend. You can see on the slide that we have thresholds in Poland. These thresholds indicate when Polish local file and TPR obligations are triggered. They are important, but I would recommend not using the thresholds as the only management trigger. In practice, the transfer pricing model should be designed before the thresholds are crossed, especially for groups planning to scale operations in Poland. From a risk perspective, the lower thresholds for certain sensitive transactions are a reminder that some flows can attract attention earlier than expected. So you can see service transactions. And the thresholds are useful, but the real question is whether the model is good and set up with according to the TP rules. Across Europe, because Poland is, of course, a part of the European Union. So across Europe, we do not have unified TP regulations. We see, of course, every country follows the arm's length principle, but we see different approaches to thresholds. In some countries, such as Poland, thresholds determines whether you need to prepare a local file, a benchmarking study, and report transactions. In other countries, there are no such thresholds, so or the rules work differently. But of course, in every EU country, we follow the arm's length principle standard.
So to speak, the arm's length principle has nothing to do with the thresholds, and it's recommended that even if we do not cross the threshold, we should make sure that our transfer pricing model or our transfer pricing report aligns with the business reality. And I think that is true for every jurisdiction across. So with that, I think if you could also tell a bit about, the major operating models, if you could touch on one or two of them, so that the audience has an idea as to how it is functioning.
Okay. So looking at Poland from a business perspective, we most often see a few operating models. So manufacturing, shared services, logistic, technology, R&D, and selected regional coordination functions. And of course, each of these models has a different tax and transfer pricing profile. For example, a contract manufacturer, a full risk manufacturer, R&D center should not be remunerated in the same way. The same applies to shared services or logistic hubs. And for Poland UAE structures, I think the practical question is how the Polish role connects with the UAE role. So whether the UAE entity acts as a principal, holding company, financing, IP, or regional platform. Once the business role is clear, I think the tax model can follow. And operating model, I think this is probably the most important message in the transfer pricing section, that, of course, the operating model comes before the transfer pricing and tax model. So first, we need to understand where strategic decisions are made, who manage the key risks, where are the people, and which entity is expected to earn which return. Because as you mentioned before, because of the tax differences between Poland and the UAE, it may seem attractive to have more profit, for example, in the UAE. But the Polish tax authorities know about these differences also, so they may look more closely at such structures. That is why the profit allocation must match the real business model. The value should be created in the UAE. There should be real business activities there, and the UAE company should be responsible for managing the key risks if we would like to have the profit, more profit, or residual profit in UAE. And of course, this is not only a tax point, because it's also a governance and finance point. So of course, if Poland performs strategic functions, the profit allocation should also reflect the reality. And also, when we translate the operating model into specific cross-border decisions, 4 areas usually require our attention. So first, services, because I think in every business model, the services are present. So who provides management or technical support services, and what is the benefit for the recipient? Second, financing, who provides capital, who controls the financing risks. And third, IP, who develops, protects, and benefits from the intangibles. And the last one, governance, where the strategic decisions are actually made. And I think from a business perspective, these are not only technical questions regarding tax, but they affect, of course, the structure, the cash flow, the effective tax rate, and so on. And I think they are also increasingly relevant in Pillar 2 environment. Also, Pranet mentioned that, where the substance and profit allocation and, of course, effective tax rates need to be assessed together.
I think this throws a lot of light on the TP environment, and you have already posed the question to Praneeth that we need to see what's happening in UAE on the transfer pricing front. So, Praneeth, if you can answer Magda's question as we move forward.
Sure, Rishabh. I think Magda has comprehensively covered all the transferring insights. I'll try not to do any overlap, but just to add on from a UAE standpoint. First, with the coverage, it's quite comprehensive. Both domestic as well as cross-border related party transactions are covered. A unique thing is, since there is no personal tax regime in UAE, any payments to the connected persons and a regular parents, your shareholders, KMP, all these are also subject to transferring, so that there is no scope for profit extraction from these taxable entities. Third thing is the UAE TP regime is aligned to OECD, which is also a good thing, especially for inbound structures. Whatever work already done in alignment with the OECD can be leveraged for UAE TP compliances. But the real burden is for the domestic or outbound groups, which is because TP is something new to them, which is embedded in the corporate tax regime. The typical TP life cycle that we had been suggesting clientele, larger businesses to follow a structured approach. First thing, the introduction of transaction, whenever there's a new transaction, or even if it is induction of transferring for the existing transactions, always do a TP fact-finding exercise, proper transferring advisory, and then do a benchmarking, which sort of becomes a first base. Well, there are a lot of thresholds for the three-tier documentation, including the TP disclosure form that goes part of the corporate tax return. Those are only compliance obligations which are threshold driven. The thumb rule is the benchmarks or the studies have to be there irrespective of thresholds. Not only for tax-paying entities, the more burden is on the free zones which are claiming the 0%, so that profits are not concentrated in these qualifying free zones. Even for small businesses who are claiming the small business relief, there is only relief from tax cash outflows, but not the compliance obligations. Bare minimum, they'll have to maintain the benchmarking studies and intercompany agreements. So phase one is to have this proper documentation at the inception of transaction. Second thing is operational transferring, which is of course new to most of them, even in evolved jurisdictions, have a proper housekeeping sort of SOPs. Where you ensure that your accounting, tax functions and decisions are aligned to the group level TP policies, right from TP workings, back-end workings to the ultimate audit defense documentation. So operational transferring is something we suggest on a monthly, quarterly, half-yearly, so that you don't end up at the time of year end having to do with substantial transferring adjustments to align your actual results with the LP policies. And of course, the transpricing compliances, as Magda highlighted, the local file, master file, CBCR, even the TP disclosures have to be viewed holistically with a 360-degree lens, so that there is alignment with whatever is mentioned in the disclosures to local file to master file. And while UAE is yet to come out with the detailed tax audit tax litigation framework, we have seen certain taxpayers, irrespective of thresholds, getting notices from the FTA asking for minimum documentation like benchmarkings, intercompany agreements. It is a connected person contracts. If it is large company, the local file and master file. So we should not wait for the risk to be tangible. Better to be proactive and not to see transferring as a compliance burden, but as a strategic tool for tax planning and also defend the larger tax position. I think Magda will agree with that. So on that note, I'll end here, Rishabh.
Right. I think both the superheroes for us on transfer pricing agrees that it's not just a year-end compliance exercise. And for UAE businesses, I think Magda's message is that life is too short to learn from your own experiences. So better look outside and learn that how risk-based audits are happening and eventually will happen even in this region. And what you should not do is to not wait until the last minute or until you get communication or a love letter from the tax authorities, I would say, saying that, produce your documentation. And at that moment of time, you are handicapped as to not having that documentation around with you. I think this theme overall resonates with the overall transfer pricing framework, the investment opportunities, and the corridor of UAE and Poland. And as a closing remark, before we take on the participant questions, we do have certain questions. No worry, I'll do take them and address it. As a closing remark, I think this life cycle of investment again resonates in both the jurisdictions where we start from the evaluation and not just directly incorporating a particular company, because we can incorporate in 24 hours, but what once is bad cannot be corrected. As Bartos mentioned, that it won't be a customized company, it will just be a company, a legal structure. So the evaluation of the market, the opportunities, and the correct legal setup and the regulatory setup, I think, becomes key. Once you have that structure in place, you establish the business, and from day zero, you start to see that what compliances are required, what are the governance steps, because compliance and governance are two separate parts when we look at the fiscal policy in taxes. So those compliance and governance steps to be taken on your day-to-day regime and operations. And then, of course, you need to expand and try and maintain as best as possible in terms of documentation, trails, emails, whatever is possible. And then, of course, look at your next steps on the expansion. So I think this theme resonates across both the jurisdictions. And if you guys have any closing remarks before I take the participant questions, please feel free. And until then, I'll read out the participants' questions. So the first question, I think, Magda, it's to you. How does the TPR form a tool for audit initiation? If you could just share, a couple of experiences.
So I think this is the most strategic tool for tax from tax authorities in Poland in case of transfer pricing, because I said before, the taxpayer have to report a lot of detailed information. So the most important numbers and information from your local file, you have to put to TPR form, which is a structured declaration, and send it to the tax authorities. So, for example, each transfer pricing person only analyzing the numbers from the TPR form could see where are the risks and which transaction should be audited because it is risky. So I think this is the most dangerous tool, I could say, in case of transfer pricing in Poland, and I see that other European countries are following this concept, because when I was speaking with one lady from the Cyprus tax authorities in one conference, she told me that Polish Ministry of Finance and Cyprus Ministry of Finance are teaching each other, and the Polish Ministry of Finance sold this concept of the TPR to Cyprus. So I think other European countries could follow this concept.
This is interesting on joint capacity building and
Yeah.
sharing of knowledge. So yes, I think it becomes a source of truth, and also, I can conclude on this that with the other information that the taxpayer files with the tax authorities, and open source information that is available, I would say that the tax authorities know more about you than you know about yourself. So it's just to be conservative, be truthful, and have the documentation. Praneeth, there's a next question to you. Could you please throw some light whether there's a proper definition for related party transaction in the UAE corporate tax law, and does it cover assignment of loan between related parties?
Yeah, well, let me try to answer it critically as well as comprehensively. Critically, there is no article defining a related party transactions. What they define is the related party relationships and connected person payments. On a coverage note, as I mentioned, all revenue capital transactions are covered. There is a detailed transpricing guide which largely embedded all the specific consideration from the OECD guidelines. It gives key consideration for unique transaction categories, be it intangibles, financial transactions, business restructurings, in addition to your regular transactions pertaining to economic activities of manufacturing, trading, and services. So coverage is exhaustive. As I mentioned earlier, all transactions are covered. And then in terms of guidance, don't purely look at the federal tax law, but also the transpricing guide and the larger OECD DP guidelines. Yeah.
Right. I think we have no question, only one comment from the participants. They say that this transfer pricing disclosure form is a dangerous tool. I hope the Polish tax authorities do not teach it to the UAE tax authorities. But sir, to your comment, unfortunately, the UAE tax authorities are already well trained. They are having internal capacity building sessions with tax authorities around the world. So they are very well equipped at this present moment of time to do a risk-based audit just from your TP disclosure form and your corporate tax return. So that would be.
I think I have a comment because that's probably the first data they have. So we don't have a compulsory local file master file filing. So it is going to be that this is the only document that they're going to see and audit. So eventually that's the starting point for all the audits. Yeah.
Right. With this, I know we have extended by 5 minutes, but that was the demand of the hour. So with this, we will end our deliberation. We have answered the questions that we've received. We thank the participants for a patient listening, and also like to inform all of you that with this collaboration with MDDP joining GTPN, we aim at helping multinational businesses navigate the cross-border tax regimes, transfer pricing, structuring, Pillar 2, controversy management, and the operational transfer pricing challenges, having local expertise, and of course, having the international execution and the center of excellence alongside our transfer pricing technology. So with this, we will close today's session. And thank you, Magda. Thank you, Bardos, for taking out the time to giving this so much knowledge to the participants. And we hope to see you in the further editions that we do with MDDP on the Poland tax and the regulatory and TP environment.
Thank you.
Thank
Thank
you.
you very much.
Thank you
Thank you all.
Thank you.
Yeah.
Bye.
Bye.
Have a
See
great
you.
day.
Bye bye.
Have a great day.
Bye-bye.
Bye.